So I'm going to try to use all of our time in as valuable of a fashion as we can, since I was given one instruction, which is don't go beyond 7 p.m. And so given that I have Carmen and Lee here, and I have a bunch of questions from reporters, and I've told them all that I'm just going to ask Carmen and Lee the questions they are asking me so that I can sound intelligent. So the first question I have for the both of you, but I'll put it to Carmen first, is about what's happened today and the implications for the global sovereign debt system. So my limited understanding of what's happened today is the US government has taken the step of making it almost certain that Russia goes into default, and I'm wondering whether that will cause the sovereign debt dominoes to fall. So maybe Carmen, you can give us your view on the logic behind this decision, and then Lee?
So how does this work?
I don't know, but you can have mine.
Okay. Okay, can you hear me? Okay. I'm not really sure what the benefit or rationale behind the decision as far as the credit rating agencies are concerned, as far as market access is concerned. Russia is in a state of default already. It's in, financial autarky. The first part is, what is to be gained? Not at all clear to me. The investors will lose out on funds that could have been transferred to them. I don't, so what the rationale, I can learn from Lee and from you, what the rationale might have been. On the domino effect, this is a very idiosyncratic situation. This is not Mexico, August of 1982, in which you had a sovereign that was on the brink with 5 other sovereigns that were also on the brink, and international interest rates, which are about to go up, but had not just gone up, they'd really gone up, When people, talk about interest rate increases, and we're talking, let's do 50 basis points or 25 basis points. Paul Volcker did 600 basis points almost between October of 79 and January of March of 1980. So we're not in that, there are more countries, I think, that are marching towards debt distress. Sri Lanka was a recent example. I'm going to conclude now by saying that on the domino side, to reiterate, this is a very idiosyncratic situation, and I don't see the kind of replay of a summer of 1982 into 1983 in the making. But that is not to say I don't think more countries are moving into debt distress territory.
Okay, so we'll get back to that. Lee, the logic of this decision, maybe it's a special legal strategy of the U.S. government.
No, I don't think the logic baffles me. The prior policy until today had been to allow Mr. Putin to pay his external debt as long as he debited unfrozen accounts. That effectively drained further liquidity out of Russia and thus amplified the objective of the sanctions. Today's decision, to my eyes, enriches Mr. Putin to the extent that he no longer needs to use his foreign currency to pay external debt. It impoverishes Western bondholders, and more importantly, probably will give Russia a legal defense in an English or American court when the bondholders get around to suing him for this default. I entirely agree with Carmen. This is idiosyncratic. Russia has already characterized this as an artificial default, and let's be honest, that is exactly what it is. This is not a sovereign that is defaulting as a result of an unwillingness or inability to pay. Russia went to the extreme of actually prepaying some coupons before this action was taken. So they are not signaling that they wish to default, they're signaling exactly the opposite. So they will characterize it as an artificial default. If the US Treasury felt that by forcing Russia into this default, it was permanently staining Russia's credit reputation, I don't think so. I think the memory of this will be what it is. It is a measure taken in the context of an acute political crisis. And I don't think it will I don't think this action will permanently stain Russia's reputation.
All right, so I confess I'm less concerned about Russia's reputation than the situation for the globe as a whole. So, Carmen, if memory serves, both the World Bank and the IMF have come out with reports suggesting that there is a large number of countries that are on the brink of debt distress, and you of course are the guru of the history of debt distress. I'm from Kerala in India and go to Sri Lanka often. I watched recently the situation in Sri Lanka get bad very fast. Russia, I hadn't realized Russia was so important to Sri Lanka, but it turns out about 30% of the seats on the planes to Sri Lanka on Sri Lanka's airlines are people from Russia, Belarus, Ukraine. Fuel prices are crucial in Sri Lanka. And the COVID had already caused their debt situation to be bad, but the Russia-Ukraine conflict served as to this outside observer, as an accelerant. And I'm wondering how many more countries you think this will happen to. I mean, has it sped up the potential for a dozen, 24 countries to go into crisis at the same time?
So, first of all, on where we are, there are 73 countries that were eligible for the debt service suspension initiative. They're low income, middle low income, and some that are called, blend countries. These are small states. Of those, about 60% are either, the debt sustainability exercises of the IMF and World Bank classified countries into 4 buckets. Low risk of debt distress, moderate risk of debt distress, high risk, and in distress. About 60% of those countries are in the high risk or in distress category already. And if you translate the ratings into a numeric scale, you see that we're heading towards, even worse territory. So that's where we are. But let me take issue, Mitu, with one characterization that I think is quite commonplace. Oh, this is happening because of Russia. Oh, this is happening because of COVID. A lot of countries were already in deep, deep fiscal strain territory when COVID broke out in early 2020. And so, the commodity crash, and I'm bringing the commodity issue because this is important also when we discuss the second part of your question looking ahead. The commodity crash of 2015, coupled with the China slowdown. This is the period in the summer of 2015 that we start seeing, China growth rate, which had been double digit from like early 2000 till about 2013, turn into settle around 6%. What has now been in recent years even before COVID, even as early as 2019, a reversal in capital flows, net flows from China. China had been lending heavily. So lack of capital flows, what had been a commodity price crash, and what had been increased borrowing, external and domestic, which is a new twist now, a lot of domestic borrowing as well, had already placed a lot of countries like Sri Lanka. Sri Lanka had already restructured with China a couple of times, even before COVID. So to conclude, are there more countries shaping up to have credit events if they're, if they have marketable debt, if they have bonds or low-income countries where, international capital market is limited but are still going into negotiations, debt restructuring negotiations with the Paris Club, or a combination of the two things. Are there more in the way? My strong sense is yes. But let me conclude by saying that what we haven't had is what I call the three shoes dropping simultaneously. In a lot of the work that I've done with Christoph Trebisch and Vincent Reinhart on commodity price cycles, default cycles, and capital flow cycles, those three. The three shoes to drop are international interest rates rising, commodity prices falling, and capital flows reversing. Okay, when those three things happen simultaneously, you can see a surge in defaults. That was 1982. We've been limping along for a while, with 2 out of the 3. Now we have rising rates, we have backpedaling significantly in international capital flows, but we have high commodity prices, which is going to keep, for obviously not the commodity importers, but for a lot of commodity exporters, that's going to be a help. But I do expect, perhaps not with the great big bang of the 1980s, but certainly a steady addition to the list of countries in debt distress. You have countries like Ghana. You have countries which, Turkey is, I don't know about debt, but certainly yeah. You have countries like Angola that are now benefiting from high oil prices, but have real unresolved issues. I could go on with the list, but it's a long list.
So, Lee, in theory, you retired, but
In theory.
I know from us having taught a class that Lee has more phone calls and emails and text messages with people bothering him over the last couple of days than perhaps I've ever seen. So is that just that you have a lot of friends, or are there a lot of countries who are desperate for your help? But more broadly, how difficult is it going to be to restructure these debts? Purely hypothetical fashion. Has it become a lot easier than, say, 1982?
No. In one sense, easier. The rise of collective action clauses has certainly helped. And if you look, their use now has facilitated debt restructurings for a number of countries. But the world has changed. The composition of debt stocks are now more diverse than they were in the good old days. I mean, one looks back with some affection for the days when you had an homogeneous creditor group of either commercial banks or bondholders. You now have, in a number of countries, creditor groups that will include unpaid suppliers, unpaid arbitration award holders, And we have no institutional mechanism for coordinating those creditor groups. The collective action clauses, remember, operate only within international bonds. They are not a solution to this broader coordination problem. Moreover, the modern sovereign debt restructuring must deal not just with commercial creditors and the Paris Club. China is now the largest bilateral creditor. They are not a member of the Paris Club. There was one small effort made in November of 2020 by the G20 to promulgate the so-called common framework, in which China agreed that it would sit together with the traditional Paris Club creditors and negotiate jointly. I thought that was a great advance, long overdue, because a sovereign debtor today has to negotiate with its commercial creditors, then with the Paris Club, and then with its non-Paris Club creditors like China, India, South Africa, and so forth. I would like to see that bilateral creditor universe coordinate and accept among themselves comparable treatment of how they're going to deal with the workout. Moreover, if China persists in a policy of wishing to pursue bespoke debt negotiations, it arouses deep suspicion in the other creditor groups. So the Paris Club will watch with suspicion whether China's settlements are indeed comparable to theirs. The bondholders, confronted with a China that in a number of these countries is a very significant creditor, have shown themselves unwilling to move forward until they know what China is doing. That requires two things. First, China must do it, and second, someone must disclose it. So in this sense, it has become more difficult to get sovereign debt restructurings done than it was in the good old days. I can't tell you, only history will tell whether it's going to take us longer to get things done than they did 20 years ago.
You didn't answer the part about are a lot more countries calling you.
No, I didn't. You asked me, I think you suggested I had a friend. And I do have a friend, and he has not called me in a long time.
So talking about China leads naturally, and I hope I can ask both Carmen and Lee about this. My memory from the beginning of the COVID days, when we were very worried about the amounts that countries would have to borrow and the increases in their debt stocks, was that it was seen, at least in some circles, that the common framework and its predecessor, the DSSI, would rescue us. So I guess my question is, I had two versions of this question. Is there hope for the common framework? But I don't see much hope, although maybe I don't understand it. So what has gone wrong with the common framework?
So this is really following up exactly on everything that Lee said and that I agree with. But let me, before what has gone wrong with the common framework, is what has gone wrong with any debt negotiation through the ages? The debtors want a haircut. The creditors want to get repaid. For those two sides to ultimately meet, it's often been the recurring long dance. Yes, we had better outcomes, shorter debt restructurings in the past couple of decades, often because of collective action clauses and the like. But in the end, when you have a new kid on the block, a new creditor like China, this is the first big boom in lending. This is the first time they're faced with fairly widespread debt problems in their borrowers. It takes a while to internalize those losses and to admit them. And that was the situation even with a much more homogeneous commercial banks in the United States. Let us not forget that the Latin American crisis and the debt crisis in general, because also it engulfed Africa in the very early 1980s. The Brady plan did not come around till the late 90s, the late 80s, early 90s. The HIPC initiative for the low-income countries only came in 96 and really was not enacted till afterwards. So you're talking about a very substantial period of time. But what was it that you asked me? I'm sorry, about China in particular. That
it's just
the common framework in particular. Well, so they're the biggest creditor, and Lee put this very well. They're actually bigger than the entire Paris Club combined in terms of what they're owed. And my sense is the mode of restructuring they have had, and they've had a lot of restructurings. There's a short paper with Sebastian Horn and Christoph Trebesch called Hidden Defaults, which is about debt restructurings with China. The key features are you offer you offer a grace period. You don't really change the face value of the debt. You don't really change the terms in terms of the interest rate. You may do some maturity extension, but for the most part, is a cash flow relief debt restructuring, which we know in the past don't work for the most part. And so they're stuck on that. And I was attending the G20 common framework negotiations, and it was very clear that anything that referenced a write-down of principle was taboo. So I think there's going to be a long slug to go from, okay, we'll do some cash flow relief, to we'll really have meaningful net present value reductions in debt, which is what the countries need.
So Lee, sticking with the common framework theme and China, so Carmen talked about, how we haven't really even gotten past the claims that were made, at least informally, that the common framework was just this big success because it had brought China into the fold, and China was now going to cooperate with the Paris Club members, and we were going to have debt reduction, and then somehow by magic, because China and the Paris Club were going to agree to significant reductions, then through the magic words of comparability of treatment, the private sector would just lay down and agree to the same reductions. My understanding is that none of that has happened, or why hasn't that happened? Or maybe it's happened in secret and we just don't know, or I just don't.
It hasn't happened because only 3 countries have availed themselves of the common framework: Chad, Ethiopia, and Zambia. None of them have yet reached a deal with their bilateral creditors. It is worth remembering in history that the debt restructuring technique used in the 1980s, from 1982 until 1990, was simply an extension, short-term serial extension, no haircuts, a little bit of debt interest rate relief on the margin, but it pushed these debt stocks out again and again and again. But it had the consequence of leaving a miasmic cloud hanging over the economies of the afflicted countries that prevented any significant inward investment or voluntary lending. Result, the economies contracted. During that 10 years, the Latins still call it the lost decade. Common Framework. The Common Framework paper is a page and a half. If you read it, you will see twice in that page and a half is there a warning that principal haircuts are to be considered only in the most extreme cases. The author of that paper was congenitally opposed to principal haircuts. I entirely agree with Carmen. There will be a number of these countries, I'm afraid to say, that need a significant reduction in the stock of their debt. Is it possible to stretch it out until the 12th of never? Of course it is. But it will have the same effect as in the 1980s. There will be a legacy component of debt that will discourage inward investment and lending, the kinds of things that are needed in order to revitalize these economies. So we may be right that extend and pretend will again be the mantra, but let us not convince ourselves that it is without cost to the debtor countries or their citizens.
So I'm going to change tacks a little bit here and talk about another topic that is very current and connects to Russia, but on the Ukrainian side of things. So one thing we have on the Ukrainian side is that Ukraine has a considerable amount of debt and is continuing to say that it will service the debt. It is servicing the debt while it is having to borrow significant amounts and get significant amounts for relief. But there are the size of the pool of claimants from Ukraine, refugees, people who've lost their lives, their families, people who have had their houses destroyed. To my mind, these are all people who have debt claims against Russian assets. And we know, at least so far, there are about 300 billion worth of Russian assets that are frozen. There has been the question of whether or not those assets should be unfrozen, and people with claims, I'm a little less sympathetic to people who funded Mr. Putin, bondholders, but let's say they didn't know what they were funding, but at least the claims of refugees and those who've lost their lives, should they have access to those frozen assets now, or should we allow politicians around the world to be able to use those frozen assets to negotiate peace subsequently, as politicians usually do?
Or shall I give it to Lee?
I think you should give it to Lee. That's my...
The Ukraine minister is now projecting that it might take $1 trillion to reconstruct that country and to deal with the humanitarian crisis that this situation has brought on. Where is that money going to come from? Most of it is going to come from the official sector, from multilateral and bilateral sources. Stated differently, most of it is going to come from your pocketbooks as taxpayers to those institutions. 300 billion, more or less, of Russian assets have been frozen. The question of the hour is, first, do the countries in which those assets reside have the legal authority to confiscate them? First question. Second question, ought they to do it? And ought they to do it now? I think the answer to the legal question is under current law, I'm unaware that any of those countries have the legal authority to confiscate the assets. They do have the really broad authority to freeze them, but it would probably take additional legislation. Ought they to do it? This is an interesting debate. There are those who say, no, don't confiscate it yet. It's a bargaining chip on the table. It's 300 billion bargaining chips on the table that might induce Mr. Putin to back off. I say no. I say that is naive. If you allow those assets to remain frozen at the time that Mr. Putin wishes to end this, and footnote, I don't think $300 billion is any additional motivation to him ending it. He'll end it when he decides he can end it. But if he comes to the negotiating table with that $300 billion still in the hands of the countries that froze it, as sure as God made little green apples, he will say, give me my money back. And he will say, if you don't, the hostilities continue. What politician, what negotiator is going to sit there and say, I'll endure another 10,000 civilian casualties, destruction of cities in order to have that 300 billion available? No politician will do that. If you leave it there until the end of the hostilities, I think there's a very good chance that Mr. Putin will get it back. And if he gets it back, it's just another way of saying you folks are going to have to pony up the additional money to rebuild Ukraine. So my view, if you have and can get the legal authority to confiscate it and make it available to Ukraine, do it now. Take it off the table. And as to your second question, will there be other claimants for that money? You bet there will. As these bonds go into default and bondholders get judgments against the Russian Federation, as investors whose property has been expropriated get a judgment, they will all want a piece of those assets. And if you defer this to the point that there are other claimants on them, all of a sudden you've got another legal issue, which is if the countries that have frozen the assets then turn them over to the Ukraine, are they taking property of their citizens without paying compensation? So that's another. Look, my view is the morally correct use of that money is to reconstruct Ukraine and use it for humanitarian purposes. And if that can be achieved by confiscating it earlier, I would do it.
I'm recording it so I can repeat. I want applause too someday. So Carmen, I'm going to give you the last question. I've been saving it till the end, but it ties back to something that you said at the start about how, many countries around the globe, a large number of countries were in a rather precarious debt situation before COVID hit. With apologies to our hosts, a number of countries in the Eurozone seem to have rather large debt stocks. And my friend Ugo showed some slides in class yesterday that suggested that Italian debt stocks are, what was it you said, Ugo? 160%? Or going higher? I'm wondering, are you worried about the Eurozone going into another debt crisis? Or do we think that the crisis if it comes, at least on the global level, is coming from the smaller countries for now. And then
I don't want to answer that question either, but I'll take a stab at it anyway. Look, if you ask me in terms of fuse, where the fuses are shortest, the fuses are shortest in the lowest income countries or in some low middle income countries that are already well underway. Those are the shorter fuses. However, I think we're facing a period of exceptional uncertainty, and this is not a cop-out. I mean, the big concern right now is, are we in for another global recession? In global recessions, just even without any incremental fiscal stimulus, what they do to revenues is well known, and what they do to debt is typically also well known. So, you know, are we out of the woods on the advanced economies, or are we going to have a replay of what we saw after the global financial crisis? The global financial crisis, remember, initially was a banking problem, and a banking problem in the advanced economies, and then it morphed, in the case of Greece, into a sovereign debt crisis, which in much different degrees also hit Spain, and it hit Portugal, and it hit Ireland, and so you really can't rule that out at this stage. You cannot. You know, I always like to remind people that if you think the numbers are high for countries like Greece, Italy, Spain, Portugal, look at them again if you take into account Target 2, which is also non-interest bearing debt. It's a very special non-marketable debt, but it is debt, central bank debt. It is a highly indebted situation. There are lots of risks to the economic outlook. A period of stagflation at the moment is something that I think is a real risk. Now, on the inflation side, the idea is an inflation part of the answer to high debt. And historically, for domestic currency debt, and for many low-income countries and middle-income countries that rely on foreign currency debt, that's not a panacea. It's actually works the other way. But for countries that have domestic currency debt, is an inflation part of the answer? The answer to this is yes, but it's a very inelegant. Let's not forget that inflation is also a very, very regressive tax. So you know, what I'm saying concretely is you can't really rule out that this whole scenario evolves for very different reasons to some of the same strains we saw in the aftermath of the global financial crisis, because don't forget also that Europe is dealing with a massive supply shock and needs to, you know, rethink, reorient its energy policy in a way that also increases those risks.
All right, well, I have uplifting, but you know, for a conference on sovereign debt, this is precisely what we want to hear, because this means that we are all, usually we are so obscure at our own institutions, but now we are relevant. So this is uplifting for us. So thank you all for your patience. Thank you, Lee. Thank you, Carmen.